Another week, another opportunity. Hi everyone. Welcome to Intelligent Investing. I'm April Tan. The market got a boost early last week after the U.S. and China put tariffs on hold, but in the end, it still finished about the same. Companies are still reporting their earnings. Some did better than expected, but most showed lingering weakness. So let's break it down, starting with our market overview. The PSEi ended the week pretty much the same, closing at 6,465.53, up by only 0.1% on a week-on-week basis. While the index managed to stay in the green, market breadth turned negative, meaning more stocks are down than up at 144 versus 122. Foreign investors turned into net sellers, pulling out 213.9 million pesos worth of stocks over the last 4 trading days. So let's look into how what looked like a promising rally on Tuesday ultimately lost steam from profit-taking and underwhelming earnings reports. Globally, the big story was the 90-day truce between the U.S. and China announced on May 12. That triggered a rally in U.S. stocks, with the Nasdaq climbing 6.7% and the S&P 500 rising 4.8% last week, erasing losses since Trump's tariff announcements back in April 2. Sentiment could turn cautious again this week after Moody's downgraded the U.S. credit ratings from AAA to AA1 last Friday. This brings it in line with S&P and Fitch, both of which had downgraded earlier. Now, history tells us that U.S. markets tend to drop after a downgrade, nearly 7% after S&P's downgrade in 2011 and 2.3% after Fitch's downgrade a week later in 2023. So, we may see heightened volatility this week, and that could spill over into emerging markets like the Philippines. Back home, let's look at the biggest movers. On the upside, we saw strong performances from GT Capital, ICTSI, AEV, Jollibee, and Converge. GTCAP went up sharply after disclosing first quarter earnings that beat expectations thanks to Toyota's 23.8% revenue growth and improving margins. Converge's profit jumped by 18.3%, with its fiber broadband subscribers growing 26.8%. ICTSI, on the other hand, went up sharply as it is expected to benefit the most from optimism around the U.S. China trade thaw. AEV and Jollibee rose. This was despite disclosing weaker than expected first quarter results, most likely because of the upcoming MSCI index rebalancing, where AEV will be added to the Philippine Small Cap Index and Jollibee's weighting in the standard index will increase. Now let's talk about the notable losers. First, we have MONDE. Its share price fell by 13%, and this was because its headline profits fell by 21.6%. But its core income went up by 1.5%, but so not so bad in general. Next, we have PGOLD. It's down by 6.8%. This was because investors took profits. Note that its share price rallied by as much as 32% from its April low after the company disclosed very strong earnings during the past 2 quarters. Next, we have the telcos. We have Globe being sold off by 6.8% and PLDT falling by 2.4%. This was after the 2 companies disclosed earnings that disappointed because of the poor performance of their mobile business and also higher than expected finance costs. Next, we have Ayala Corporation. It's down by 4.7% and Bloom down by 2.6%. These 2 companies also disclosed weaker than expected profits, and Bloom was also negatively affected by the MSCI rebalancing as it will be removed from the small cap index. Let's now move on to the earnings summary. So for last week, we had 19 companies disclosing their first quarter results. There were just 3 beats: GTCAP, FPH, and MAC. However, there were more underwhelming results, with 11 out of the 19 companies disclosing weaker than expected results, led by telcos, consumer companies, and holding companies. Telcos disclosed weaker than expected results, with Globe disclosing a 21.7% drop in profits and PLDT disclosing a 5.8% decline in earnings. This as their mobile phone business disappointed due to lower average revenue per user and higher than expected finance cost. The silver lining, though, is that both companies enjoyed stronger demand for their fiber broadband business. Their fintech business also did well. GCash was able to increase its earnings contribution to Globe by 86%, whereas Maya finally turned around, contributing 143 million pesos in earnings from a loss of 376 million. On the consumer sector, we have EMI disclosing a 43% drop in its core earnings as it suffered from lower whiskey sales, which fell by 14.1%. The share of its higher margin single malt whiskeys also went down, and this contributed to lower margins. It also suffered from higher expenses. MONDE enjoyed a 1.5% increase in profits. However, what was disappointing was that its noodle business suffered from a 2.9% decline in volumes and a 1.6% drop in prices. This materialized as consumers traded up during the first quarter. Then we have Jollibee disclosing a 7.5% drop in net income. Although its earnings before interest and tax increased by 17.6% as it benefited from the strong performance of its Philippine business and the turnaround of its international business led by coffee, offset by Smashburger in China. It suffered from a significant increase in interest expense because of higher debts and higher interest rates on refinanced debts, and also a higher effective tax rate. Finally, we have SSI. Although net income increased by 14%, it was lower than analyst expectations as its same-store sales growth slowed. On the conglomerates, we have Ayala Corp. Earnings were down 4.2% because of the poor performance of Globe and ASEN. Next, we have AEV, whose profits fell by 35.7%, and this was due to the disappointing performance of AP and Union Bank. Finally, we have JG Summit, whose profits fell by 12.5%. The significant drop in Cebu Pacific's earnings came as a big surprise to us because the company actually enjoyed a 26.3% jump in its passenger volume. It also disclosed a 47% increase in cargo volume, so you would expect the company to disclose stronger than expected profits. However, Cebu Pacific was hurt by a 66.7% jump in repairs and maintenance expense, as the number of planes grounded were 5 more than expected at 13. On the macro side, Philippine inflation is expected to stay within the target through 2027. This is according to the BSP, based on its survey of economists. Forecast right now is 3.1% for 2025, 3.3% for 2026, and 3.4% for 2027. Barring major shocks, this gives the BSP some room to hold or even ease interest rates if needed. What we found interesting in this article was that the BSP felt that interest rates were tight right now, so most likely it will cut rates in our opinion. Overall, macro conditions remain manageable, but we need to stay alert for external shocks, especially from the U.S. Now, here's what to look forward to this coming week. U.S. market reaction to Moody's downgrade, local stock flows ahead of the MSCI rebalancing deadline on May 30, and more first quarter earnings. Bull market is back. So last week, the major headline was U.S. and China pausing tariffs for 90 days following escalation of trade tensions. And of course, we saw markets going up sharply, seen as a step towards normalization. But that said, we think it's premature to call this the start of a new bull market. And here are the reasons why. For starters, the baseline tariff is still 10%. Now, this is up significantly from the 3% tariff that existed before Trump came into power the second time around. So this means Americans will have to pay higher prices, meaning they have less spending power. Next, the truce is only temporary and it will only last for 90 days. We don't know what will happen after that, if the tariffs will stay on pause or if Trump will increase tariffs again. This uncertainty will hurt the decision-making process of both the consumers and businesses, and we don't know if the businesses will pursue their investments or hire more people because of this uncertainty. Beyond trade, the U.S. economy is also showing signs of softening. Non-farm payrolls are up by only 144,000 during the first 4 months of the year. It was much higher at 217,000 in 2023 and 168,000 in 2024. Meanwhile, the unemployment rate was at 4.2% as of April, and it's up significantly from a low of 3.4% in April of 2023. Delinquencies on credit card debts and auto loans are also going up and are now at levels last seen during the global financial crisis. And finally, the University of Michigan Consumer Sentiment Index is close to the worst it's been on record. Meanwhile, the Fed's benchmark interest rate is kept at 4.25 to 4.5%. In other words, the Fed has not cut rates this year. This is because it's worried about inflation. So the high interest rate poses as a challenge for both consumers and businesses because high borrowing costs would dampen their spending and cause businesses to postpone their investments. So why does this matter to the Philippines? Well, historically, the U.S. market has never entered a true bull phase amid a recession. If U.S. stocks fall because of an economic downturn, the Philippine market will most likely follow suit due to contagion. Given the current backdrop, buy on dip, sell on rally strategy remains the most prudent for local investors. Use market rallies as an opportunity to lock in gains and stay liquid to take advantage of select opportunities as prices go down. If you found this market rundown helpful, don't forget to subscribe for more market insights every week. A new week is a new opportunity. Remember to stay sharp, stay selective, and as always, invest intelligently.